What is going on, property management friends? Reece here. I'm going to be your host of This Week in PM this week. Jeremy and Jen decided to take a little time off to do this crazy thing called learning. They're actually on an offsite visit to do some higher learning so that we can actually bring some of those elements back to our property management friends and make sure that we're continuing elevating everything that we do here at Strategic PM, but also at Rent Scale as a coaching team. So initially, they were actually going to cancel this Week in PM. So what I did, I hacked in, I got the passwords, and I am going to be your guide through today's episode. So looking forward to it. I've got some really cool special guests inside the BDM community that I coach every day here at Rent Scale. And we've got some interesting things that we're going to talk about and how it impacts our property management business as a whole. We just heard yesterday that the feds are dropping the interest rates by 0.5 percentage point. So we're going to talk about how that could directly or indirectly impact our property management business now and in the months to come. It's a really exciting time right now in property management. We've got some really cool data that we've kind of accumulated over the summer and how we're coming out into the latter part of Q3 and Q4, and we're excited to have that conversation today. But while we're waiting for everybody else, and I get to have fun with all these cool buttons that Jeremy gave me to do all kind of cool things, let's go ahead and look at a highlight from one of our previous episodes.
So the $1 trillion time bomb is the insurance issues that may come from the catastrophic weather that we're having, from climate change and from more fires and more hurricanes and all of the things that we're watching happening all over the US, combined with the increased costs of repairs and materials and all it takes to basically rebuild. All of us that own property or even automobiles are watching our insurance costs go through the roof. And over the last probably 4 to 5 years, I've seen my insurance costs triple. And the combination of the expense that it's going to take to replace the catastrophic damage like that and the increased danger and issues that we're having with climate change are basically showing that we are so out of whack from what the average person is paying in property insurance versus what it would take to actually repair.
So one thing I've noticed just taking over the studio for the day is hair and makeup team. They left with Jeremy too. So Jeremy looks way better on camera than I ever will. But next time when I do this, I'll make sure the hair and makeup team stays in town, doesn't travel with Jeremy so that we get a better camera angle. So be sure you subscribe to us on YouTube, LinkedIn, Facebook, Twitter, so you can get all the access to these live episodes as well as the recorded. We do this every other week so we can talk about what's going on this week in PM, and we want to continue that. So let's move on a little bit. Let's talk about some industry news. So if you don't know who I am, I'm actually one of the scale coaches inside of Rent Scale. So I have the luxury of talking to about 70 members of the property management industry, specifically BDMs, on what's going on in their world day after day. I enjoy the heck out of this. I come from the industry. I've been in the property management space for about 6 years now. So it's truly an honor to get to see what everybody has going on across the country in one of the largest communities of property management sales professionals. So one thing that I want to talk about as far as industry news that we're seeing out of conversations inside of Scale Club is the increased days on market. We haven't really seen a decrease in the amount of property management leads that we're getting. We haven't seen a decrease in the conversion rate. Everything seems to be very on point and on target to where we want to be. The flip side is as we're signing these properties up, we have seen a general topic keep coming up, and it's longer days on market for these properties that they're signing up. So instead of what we've been used to in the last 2, 3, 4 years where properties were leasing under 28 days, we're seeing the average days on market shoot up in some areas of the country to 40 to 60 days. So what are we doing to adapt to that? Something that we talk about often in Scale Club is how we position and make sure that we have the right owner expectations in place from the initial conversation. So we're having to dive a little bit more in detail to that, but it is something that we have to stay alert to because this is a trend that I do believe we're going to continue seeing as an influx of those accidental landlords have come in and they're looking for a solution from us as property management professionals. So something for you to keep in mind in your market, make sure that you're very in tune on what the trends are, not necessarily just the snapshot of what's happening today, but where is it going? So make sure, pull that data, see where your days on market with your own inventory is, but also all the other inventory, the rental inventory in your area. And it's something that you want to be able to present to potential clients of yours and show them what direction that you're heading. Trends are 10 times more important, and they're easier to articulate than it would be a snapshot of what's happening today. So that's one of the industry trends that we've been seeing inside of Scale Club, and we're relentlessly working on our language to make sure that we're positioning ourselves as the experts, as the trusted advisor, and relaying that message to potential prospects. It's a great conversation to have, but again, it's not slowing down the door signups on the front side. It's just making sure that we're executing on the back side, which comes down to making sure we get those owner expectations from day one on the same page as we can do on the property management side. With that said, let's go in. There's this handsome guy that shot a commercial for us. So let's see what that looks like and hear a word from our sponsor. Hi there. Did you know that RentScale hosts one of the largest communities of property management sales professionals in North America? Well, my name is Reece Register, and I'm actually a previous BDM and currently a scale coach here at RentScale. We provide over 20 hours monthly of teaching and training and accountability to make sure that our BDMs are supercharging their sales business through inbound, outbound, and allbound. So if you're interested in learning more about supercharging your business, go over to rentscale.com. We'll be glad to schedule a consult and see how we can help you transform your business today. So that guy got the hair and makeup treatment. Gosh, he was such a stud. All right, so let's jump into our main segment for today. So being inside of the Scale Club community, and we had an interest rate drop yesterday, what I wanted to do is bring in some of our highest performing property management BDMs in here with me today that I coach every single day and have a conversation around that. We're going to talk a little bit about what the interest rate is, how it's going to impact our day-to-day business, how it impacts the real estate market as a whole, or if it doesn't do anything at all. So let's go ahead and bring in on our three guests. We've got Shay, Alyssa, and Kaylee. And what I want to do before we get started is give them the opportunity to introduce themselves. Part of the RentScale community and development path is to make sure that we're constantly developing our BDMs both personally and professionally. So it's a great opportunity for them to get a little bit of public speaking and also share the knowledge, deep knowledge that they have for their individual markets. So Alyssa, I'm gonna let you kick it off. Go ahead and give us an introduction of where you're at, what your market is, and a little bit about you.
Absolutely. So my name is Alyssa Dunphy. I run business development for Keyway Property Management, which is Augusta's largest single-family property management company. It has been a ride, but so far so good. The Augusta market is thriving, thankfully enough.
Awesome. Yeah, you've had quite the journey this past year. Awesome. Well, I appreciate you coming on today. Kaylee, go ahead.
Hello. Yes, my name is Kaylee Sanchez. I'm with 1836 Property Management in Austin, Texas. Been doing it for about 3 years, and we've been in business for about 20 years. So tons of knowledge to share and ways to help our investors.
Awesome. Appreciate you coming on today, Kaylee.
Absolutely.
And then I think now, Shay, this is the third time I've seen you today. So go ahead, Shay, give us a grand intro.
Nothing grand. Thanks for having me here, Reece. My name is Shay Murray. I'm with GC Realty and Development. We're a property management company that works in the greater Chicago area. We've seen, a lot of good business over the last couple of years. I've been with the company for 2 years and excited to share what I can with you.
Awesome. Appreciate all of you coming on today. Being that we hacked into this show, I thought I'd bring in some of my friends of RentScale to kind of help me navigate through this and make it a little bit fun at the same time. So let's talk about the interest rate drop. It is the topic of discussion right now. It's the buzzwords. It's what everybody has been waiting on. But what people don't really understand is how this may or may not affect us in the property management space. So let's talk about it. And just kind of want to open this up. Have higher rates slowed down buying new properties in your area? So specifically investors. So whoever wants to jump in first, has the higher rates that we've seen in the last 18, 24 months actually paused investors from entering the market?
Yeah, I'll jump in on that, Reese. I think that over the last year and a half or so, as we started to see a little bit of a stabilization there, it has slowed down some of the traditional investors. I think that there's been maybe a rise in the accidental landlords because of that. There's a lot of people that ended up buying 2020, 2021, whether on purpose or accidentally, that came in at a really competitive rate. It's been a lot more people like that rather than your traditional investor hunting for a good deal at cheap debt. So that's what we've seen in Chicago a lot of.
Chicago has a huge multifamily market, very different than Augusta or Austin. I mean, it's a big portion of the business that you guys go out and look for. How has the conversation been different between maybe that small to mid-sized investor looking at duplexes to quads to maybe a little bit more sophisticated investor that has 20, 30, 40 units or more? Have you noticed any differentiation on how they view the market based on what the interest rates are now?
Yeah, I mean, I think that that's an interesting question. I mean, one thing that we have a ton of in the Chicago market, specifically in the city, is 2 to 4 unit multifamily buildings. So it's a great place for people that want to house hack or kind of try to get their feet wet with the real estate investment space. But those people are typically buying on 30-year fixed rate mortgages. So those people have kind of had to sit on the sideline over the last year and a half or so because that debt has been so expensive. And at the same time, you've also seen a decline in the inventory. So the only people that seem to be really finding those 2 to 4 unit style deals are the people who are a little bit more experienced investors. And then on the flip side, I think that what you see is, it's a different type of loan product on the commercial debt space. And a lot of those people, they maybe got in the 2019, 2020, 2021 time. And maybe some of those loans are coming due now. But typically in the property management space, the type of people that we would be talking to are people that are trying to buy. So especially over the course of the last year, I think a lot of people have been hesitant to jump in with the uncertainty. I think that it's almost less the rates themselves and more the volatility of the market. So that's what I'm saying.
Interesting perspective. So Kaylee, in Austin, it was one of those areas that exploded post-COVID and had tremendous growth. That's one of the areas that Rentscale and our team go out to 2 or 3 times a year for events. It's where we're doing our annual event later this year. And it is just amazing at the growth. And I mean, even when you drive through all the construction going on. So you're dealing with it every single day. Tell me how, from your vantage point, how the higher interest rates have slowed down or maybe not slowed down the investors coming into the market.
Yeah, great question. I definitely think it's impacted it a little bit, but I think as long as the Austin market, it's continuing to grow. The smart investors still see the value. So it hasn't slowed it down too much, but there's definitely some people still on the sidelines on thinking that Austin kind of the bubble popped or whatever it may have been. But yeah, for the most part, it hasn't really impacted it too much.
Yeah. I mean, just driving through when we go out there, you can just see the growth. And I'm not even from there, but just putting my eyeballs on it and seeing all the infrastructure going up, that's just, those clear indications of growth. And I definitely think it has not peaked out yet. I think it's starting to expand out. That's what's going to happen overall. So very, very interesting. Then we got Augusta, Georgia, home of the Masters, by the way, with Alyssa. Y'all are in a little bit different market. It hasn't been pegged as one of the premier investment markets. So from your perspective, what's the investor sentiment in Augusta right now?
So I will say Augusta was just rated #1 safest place across the U.S., which is crazy. Didn't expect to see that the other day as I was just flipping through the news articles. But what we have seen a lot more recently with the higher interest rates is a lot of out-of-state investors are looking into this market. Everything is cheaper in the South. So they're seeing these larger scale properties for maybe a little less than what you would pay as opposed to Austin, Texas. So we have seen a lot of that kind of stay the same, in all honesty, increase maybe a little bit. But what we've seen a big decrease in is our local investors. So our smaller investors that maybe have 1 to 10 doors, they're not able to invest as much as they would with the higher interest rates, with the cash flow, the price of properties, and everything along those lines. So we've seen a little bit trouble in our local market, but investors coming in out of state are still able to get some awesome deals even with the higher interest rates. So hopefully that will only continue as they drop down.
Yeah, hopefully it's one of those markets that rises up out of all of this that people were kind of looking at. Now there's an interest rate drop. Maybe they start flooding in, which kind of takes me to my next question around this. The higher interest rates, they may have slowed investors down overall, but one thing that it has caused the emergence of again is accidental landlords, right? That's like the other side of the equation. All of these property owners that couldn't sell their homes, they look to come over to us to rent it out for a brief period of time. And our job as sales professionals is to take an accidental landlord and put them into an intentional investor mindset. So has in your markets, with the higher interest rates coming out of the summer specifically, have you seen an influx of those accidental landlords calling when their property's been on the market for 60, 90 days and haven't sold? Have you seen them calling and looking for a rescue? And Shay, I'll start with you.
Sure. Yeah, I think that there's a lot of truth to that. I think that there's a lot of the types of calls that we have are people just naturally trying to make the decision between renting and selling. So sometimes we catch them before they actually make that decision. We have the opportunity to explain the benefits of renting, long-term and short-term, arguably. But yeah, I would say that especially over the summer, there has been an increase in the amount of people who have it on the market. Maybe it's gotten stale. And their agent or them are looking for another option because at the end of the day, they're planning on moving either way. I mean, in the real estate world, people are going to death, debt, and divorce, right? The 3 Ds of real estate. So there's going to be reasons that people are going to want to move that have nothing to do with the economy as a whole. And we've definitely seen an increase in those as it's been more complicated to buy and their listing gets stale. And then on top of that, when we had those times where the interest rate was falling, and the prices were skyrocketing, everybody has this perception that when they put the property on the market, not only is it going to go for $10,000, $20,000 over list, or I guess more based on a percentage, but also that it's going to get scooped up right away. So as soon as it sits on there for 2 weeks, they get spooked because their neighbor or their cousin or their uncle sold their place in a day just a couple months ago. I don't understand what's going on now. So we've had a lot of conversations like that in the Chicago market, I'd say.
Very, very interesting. So Kaylee, for Austin, a little bit different dynamic. You guys have had this huge influx. You had tons of people buying houses in the last 2 to 3 years. Are you seeing in Austin, Texas, the same kind of thing happening? Like, what's the phone ring been like as far as accidental landlords coming in the last part of the summer?
Definitely influxed. So I would say very similar to Shay. Yes, a lot of people just looking to make the best decision. Their house isn't selling, but I would say also it's bringing them down to reality and letting them know it's not the same, even in the rental market, as it was 2 years ago. You're not going to get, multiple offers. You're not going to get this sky high rental rate that they would back then. So it's letting them know, yes, we can rent your property, but here are the expectations that you should expect when also trying to rent your property. So it's been a lot of those conversations, but it's been a lot of conversations with realtors as well on how you can help their clients, which has been super helpful for us.
Yeah. I remember when I was in the role, that 2020, late 2021, early 2022, and we would get these new properties that were signing on left and right. And pricing out a home then was the easiest thing that could have ever been done. You just basically spin a wheel and whatever number it landed on, and it would lease. And those were like the glory days. And now we're trying to do the exact opposite. It's taking a little bit more skill to price out the homes and meet the owner's expectations, but also letting the owner know that that environment is over. So we have to be a little bit more strategic than we did in the prior years. So Alyssa, talk to me about Augusta, Georgia. I know that you guys get a ton of single family accidental landlords. So how has that changed coming out of the summer this year with the higher interest rates kind of sitting there for a while? Have you seen the phone ring more with those types of leads?
It is. And a lot of that is that same conversation. Do we need to sell or do we need to rent? Because a lot of these owners we're in a military town, so the typical move is every 3 years. So a lot of these owners got in at those lower interest rates, and they don't want to give that interest rate up. Are we ever going to see 2% again? Lord only knows. So they don't want to give it up, but they're not quite able to rent it out for enough to cover their mortgage and escrow, taxes, insurance, the like. Comparatively, if they sell, it might sit on the market for 90 plus days. So we have had a lot of those conversations of just which way do we need to go. And hopefully with the decrease, those that have been wanting to buy, they've just been waiting for a couple point drop, will kind of hop onto it now, but they also might be waiting. I mean, the Fed mentioned that they're going to be hopefully decreasing again before the end of the year. So maybe they're going to keep holding out, and we're going to keep homes on the market until those accidental landlords get to a point that they can't afford to continue to have it sit, and now they have to rent, and then they just get in a sticky situation.
Yeah. Which, now let's get into some controversy stuff. Let's start theorizing a little bit. So we've got the groundwork laid. This is where it's going to get fun. I know Shay's like itching to kind of get into the controversy. That's one of his strong suits. So we had an interest rate drop yesterday. A lot of predictions were around a quarter basis point, but they went down to a half. And there's talks about another interest rate decrease before the end of the year. So here's my question. I'm going to leave it kind of open-ended because I want to hear exactly what your mindset is. And Shay, you can lead off the controversy here. Are interest rates going to impact your property management business? The drop of half a basis point yesterday.
I think that the answer is, are they going to actually impact underwriting and the people's pro formas when they're trying to make a decision about purchasing an investment property? No. But do I think that there's going to be a lot more people thinking about the possibility of investing? And just by nature of the perception of what it means to have the federal funds rate move, you're going to have more people that are interested in moving. And the more people that are moving in the industry, the higher likelihood that people are actually going to start buying investment properties again. So I do think that we'll see an uptick, particularly in the Chicago market, of some of those first-time investors that maybe they don't fully understand that, you know, a change in the federal funds rate might not directly impact their loan percentage. It doesn't really matter. If they think that they're going to be able to get cheaper debt, or if they think that now is the time to buy, then they might jump in with 2 feet and try to take advantage, and then ultimately call a property manager. So if you're in Chicago, give me a call.
Nice plug there. Well done. He's well trained, by the way. All right. So Kaylee, Austin, Texas. How do you think a 0.5% interest rate drop is going to affect the investor market in Austin? Do you think it's going to bring people off the sideline, or does nothing happen and we keep going on like we are right now?
Honestly, my thought is that it will bring people off the sideline. I think everyone's kind of just been waiting for the drop. They might wait a little longer, like Alyssa said, but I think it will get some more movement. I don't think it's going to make a huge impact to our market, to our business. So yeah, I think there might be a little flux, but I don't think it's going to be anything to brag home about.
Yeah. I think this is more of a stabilization maybe for Austin than an actual driver, but only time will tell. This is all kind of just, our market expertise. So Alyssa, different market, haven't had, we just talked about investors haven't really looked at it majorly until now. Does this bring investors into your market? Do you think there's a spark there by a 0.5 point percentage rate decrease?
I think that's the only time it's really going to make an impact for your local small investor, for your accidental landlord, for your tenant looking to maybe buy their first house. It's not enough to make a big enough impact, but where it does make a big impact is your large scale investors, your corporation companies that are looking to come in and take over as much as they can, as fast as they can. That cheaper debt is going to look a lot more enticing to them, as opposed to the smaller investor that is still worried about the volatility of our financial market in general, where we're at now. So I think we might see a smidge of growth, but in all honesty, I don't expect it to completely change the Augusta market with where we're at.
Interesting. And I think that brings me to my next point is it's all about the messaging behind the interest rate drop and who it's coming from. That's going to ultimately determine how it goes in your local market. One of the things that Kaylee brought to my attention today. With the interest rate drop, she had a client that she actually signed up here recently that their real estate agent called them and said, hey, the interest rates have dropped. Now's a perfect time to sell your home. So that messaging from a real estate agent caused an accidental landlord to shift over back to trying to sell it. So from our perspective on the property management side, how can we as an industry put the right messaging out there that maybe an interest rate decrease isn't a shift to the seller's market, but it actually improves your rental property financial outlook for the long run? So Kaylee, talk to me first of all a little bit about how that conversation went on when your client that you signed up pulled out and wants to go back to the seller's market.
Yeah. So it's really giving them the big picture, the full picture, not just the one-sided picture that the agent is telling them, right? So it's understanding their goals, making sure that that is still achieving their goal rather than this is a quick decision because they think it's the right decision because things are now moving and somebody said things are great, so you might as well do it. So it's really understanding those goals in the beginning. Now they are investing in more properties. They have other properties. This isn't their only one. So I think this was maybe a way out for this particular property and she kind of jumped on it. But even that conversation was like, hey, we still have more properties that you'll be managing. This was kind of our out for this property. So I think it was aligning with their goals as to why they went that route. But in the beginning, always understanding their goals to make sure, like, if we need to bring them back to reality, then we can and kind of go back to what they originally wanted with renting the property.
Interesting. Just all comes back to that messaging. What I was a little fearful of is we're going to have agents kind of playing that game and using the interest rate drop to pull back all those accidental landlords. But it's our job on the property management side to re-educate and reframe the situation. So Shay and I were talking this morning, and I wrote this down. It's kind of a controversial question. Again, back to Shay for controversy. Is property management services a luxury or a necessity? And how we frame that up and teach a potential prospect that wants to work with us, maybe for the first time, or even an experienced investor, how we message things like the interest rate drop is extremely important, that we need to position it. It's not just a luxury, it's a necessity. So Shay, I want to bring you in and kind of go down that path that we were talking about this morning. Is property management a luxury or is it a necessity?
Yeah, I mean, I think that it's a good question. I mean, when you boil it down to what is the value proposition of a property manager, is it to save you time? Is it to get you better maintenance prices? Or is it something where, hey, I don't really want to deal with it, so I'm going to hire this guy to do it for me? I think, to be honest, the beauty is in the eye of the beholder. I think that it is the way that you present the information, and also it could be a case-by-case thing. I mean, you may have an accidental landlord who is moving 2 houses down the street where maybe it is a push to get them to hire a property manager because I just want to be able to walk over to my place and collect the rent by cash from my tenant. But if you have somebody like Alyssa who's in Augusta and you have somebody from California purchasing an investment property, it's going to be very, very difficult for them to manage the property on their own. So that's the case-by-case nature of it. To me, I think that there's a lot of necessity in mitigating the risk that comes with owning a rental property by having somebody that has years and years and years of experience watching out for it. It works to me in the same way that insurance does. You know, you don't have your health insurance for when everything is going well. You have it for when you got to go to the doctor. And in the same way with property management, yes, there's going to be, maybe it's an easy single family home. We have a great tenant. There's no maintenance issues and nobody calls us for a year. You're not paying us for that time. You're paying it for when the person loses their job and paying rent becomes complicated and you need somebody to navigate the eviction process with a complicated set of local ordinances. So I think that framing it in that way is accurate and also paints it as a necessity. I also want to just real quick, while I have the mic, comment on what we were talking about before about the drop and the perception. I mean, I think the real angle is, what is the value of having a rental property? I mean, it's not like a stock. We're not day traders, and people who invest in real estate are not trying to take advantage of a dip or a quick jump in the market. I mean, if you were buying a rental property, unless you're going to buy 150 of them, the cash flow is probably not going to make you be able to retire tomorrow. The thing that builds your wealth is the equity over time. And so a minor drop over a few month period in the federal funds rate that may or may not impact the 30-year mortgage rates is not necessarily going to be a decider for me on whether or not I'm going to sell my rental property. I'm holding it so that I can build the equity and then gain that wealth over time to put myself in a position for when I'm older. So that's my thoughts.
And that's where the messaging comes in, right? Like, we can take this moment that happened yesterday and they dropped it a 0.5 percentage point, and how do we articulate that to the prospects that we want to work with? How do we tell them that truly it's not going to impact you today? It's not a snapshot. We're looking at a trend. We're looking at something that's patient money over time. We're trying to get wealthy. We're not trying to get rich. So how we take that news and message it inside the property management world is going to be pivotal to make sure that clients are still attracted to that they don't see an interest rate drop and they want to go sell. We want to encourage investors to buy. We want to encourage accidental landlords to now be an intentional investor and show them that when the rates go down, if the market improves over time, not instantly, but over time, they actually can have a huge wealth driver that they've already got a specific mortgage payment on. So they're not fluctuating on all of that. It's actually a safer investment. And that's really where I wanted to round this segment out at, is you need to take the messaging and make sure that we're articulating it right to our audience in the right way. So in our world, we want people to rent out properties, and we need to show them the benefits on how a rate decrease can actually help them in the long run build more wealth. So we need to paint it in the positive light, not in the light that a lot of our community, like in the realtors, are going to paint this as, hey, you need to sell your home now, versus, hey, we should buy more homes now that the interest rate's going down. So it's a little bit of a flip in our terminology and reframing it. And that's where us as professionals, we need to get the message out as much as we can. That's why we talk about prospecting. We talk about going to networking events so that you can share that message from the property management world. But all in all, I do think an interest rate drop is healthy for our real estate business overall for the long run. I think it stabilizes us. Will we see 2% and 3% interest rates again? Probably not, and that's okay. But if we can stabilize the market as a whole, it's going to bring a lot more confidence in our investor buyers. And it's our job to train the accidental landlord to be an intentional investor and how it can truly change the trajectory of their financial situation over time. So Alyssa, Shay, Kaylee, I appreciate all of you coming on today. It's always good to spend a little extra time with you outside of Scale Club, getting different perspectives. It's how we grow as a community. It's how we move this industry as a whole forward. So again, I appreciate all of you coming in. And with that, let's get a word from our sponsors.
This episode is brought to you by Strategic PM, the magazine for property management entrepreneurs and executives. If you go online to strategicpm.com today, you're going to find an entire website full of content written about your industry and by your peers. And it's completely free to sign up. Just go ahead and click on the create a free account right in the upper right-hand corner. When you click on that, not only can you create a digital account, but you can actually add your mailing address, and we will send you a free 1-year subscription of the print magazine, which will be showing up in your offices every single quarter. So if you take a look inside the magazine, what you're going to see is that we are focused on growth. We've got 5 pillars of Strategic PM: vision, strategy, culture, marketing, and experience. You're going to be seeing some great high-class content from some of the best thought leaders in the industry talking about the matters that matter the most to your business. So sign up for free today at strategicpm.com and look for the magazine in your office.
It's awesome. So we're going to move into our calendar segment of all the upcoming events. And what I thought was funny that I'm taking over this show today is I didn't do the digital notes. I actually wanted to feel like a news broadcaster, and I actually printed off this entire production note so that I felt like I was somebody on live TV. So it's been a cool experience. So what do we have coming up? October 8th, we have the Biz Dev Seminar in San Antonio, Texas. Then October 21st through the 24th is NARPM Nationals in Dallas, Texas, where our entire community is going to get together out there. Should be a great one to go to. And then we have in December, Lead Simple University, the 3rd through the 5th. That's in Austin, Texas. And then that Friday, right after Lead Simple University, is Rent Scale's Sales Mastery event, which is something you don't want to miss. We have a lot of people coming out there that are doing both events, staying the whole week in Austin. Just heard from Kaylee on how much it's growing. We're going to try to get into a Joe Rogan comedy show that week as well. So encourage everyone to come out, check out Sales Mastery Live. So I appreciate all of our guests coming on today. We're going to start to wrap things up here. It's been an honor to kind of jump in and hack the system. I will probably get a phone call from Jeremy and Jen here shortly and ask me what the heck I did with this, but I hope you enjoyed. It's always fun to change things up, give you a pattern interrupt, and come on here and some fresh faces, and also get to talk with some of our top performing BDMs throughout the country. So check us out, Strategic PM online, and we look forward to seeing you on the next one. Thanks so much.